Imagine this. You go to bed on a Friday, everything seems fine. You wake up on Monday, and millions upon millions of dollars in savings have just vanished from the gold and silver markets. A complete wipeout. It sounds like a Hollywood thriller, right? Well, it really happened, and we're about to break down exactly how. So the big question is, how on earth is that even possible? What could possibly trigger a financial collapse that's so sudden and so brutal? That's what we're digging into today. We're going to go step by step and really investigate the hidden forces that can bring an entire market to its knees. And the speed of this thing was just terrifying. It all starts with an announcement on a Friday, and then silence. The markets are closed for the weekend. You can just imagine investors everywhere holding their breath. By the time Monday rolls around and things reopen, the cascade turns into an avalanche. A single weekend was all it took. Now, just look at these numbers. This wasn't some gentle dip. It was an absolute freefall. On that very first day, gold dropped over 9%. And silver? It collapsed by a mind-blowing 27%. These are the kinds of moves that literally erase fortunes in the blink of an eye. So, what was the spark that lit this fire? Well, believe it or not, it all started with a single announcement. The White House was about to name the next chairman of the Federal Reserve. And you've got to understand, this is arguably the most powerful economic job on the planet. Their decisions on interest rates can literally change the fate of economies around the world. And this was the name that sent a tidal wave through the financial system. Kevin Warsh. Now, for you and me, it's just a name. But for the market, oh, this one nomination completely shattered every single assumption they had about where the economy was headed. And to understand why, we need a little backstory. You see, for months, there had been this high-stakes war of words going on in Washington. On one side, you had President Trump. He was publicly and very loudly pressuring the Fed to do one thing and one thing only: cut interest rates. This wasn't some friendly debate. It was a bare-knuckle brawl over the future of the economy. And this was the core conflict. It was a classic economic tug-of-war. Trump wanted to slash rates. He saw it as pure rocket fuel for the economy. But the Fed, they were terrified that doing that would unleash the monster of inflation, the very thing they are paid to keep in its cage. So what was Trump's angle here? Well, it came down to three main things. First, with a national debt north of $36 trillion, lower rates means saving billions in interest. Makes sense. Second, he hoped it would cancel out the price hikes from his own tariffs. And third, and this is the big one, cheaper loans for everyone would, he hoped, create a huge economic boom just in time for an election. So the market, thinking it was ahead of the game, made a simple bet. They were all in on the idea that Trump would pick a dove. That's Wall Street speak for someone who loves low interest rates. So investors piled into things like gold. But the nomination of Kevin Warsh, it threw that entire bet right into the garbage disposal. And here's where things get really interesting, because no one could figure this guy out. On one hand, his entire track record screamed hawk, an economist who believes in high rates to crush inflation, period. But he had also gone on record criticizing the Fed for keeping rates too high. So which was it? Was he a hawk or a dove? Nobody had a clue. And the impact was instant. You can see it right here. Before the announcement, the market was like 90% sure that rates were going down. But after, poof. It became a total 50-50 coin toss. All that certainty that people had bet millions on, it just evaporated overnight. So investors all over the world started doing some very simple math. They thought, wait a second, if there's even a chance that rates stay high, I can get a guaranteed 4.5% return just by holding US dollars. Gold, on the other hand, pays me exactly zero. Suddenly, holding gold looked like a bad bet. The smart money started selling. But hold on a second. A shift in sentiment. Okay, that explains a market drop, a correction. But a complete, cascading collapse that wipes out fortunes? No, for that to happen, you need something else. There was another, much more dangerous force at work under the surface. And here it is. This is the real villain of our story, a powerful and often hidden tool called financial leverage. This is the secret ingredient that took a simple market dip and turned it into an absolute unstoppable disaster. So, what is leverage? Well, in the simplest terms, it's just investing with borrowed money. Think of it like a magnifying glass for your investments. It makes the good times incredible, but it makes the bad times catastrophic. It's a true double-edged sword. Let me just walk you through how it works. Say a trader wants to buy $100,000 worth of gold. They don't actually need that much cash. Instead, they put down a small deposit of their own money. That's called the margin. Let's call it 10 grand. Then they borrow the other 90,000 from a broker. And just like that, they're controlling a $100,000 asset with just 10,000 of their own money.
And this right here shows you the two wildly different paths this can take. In the happy scenario, gold goes up 10%. The trader sells, pays back the $90,000 loan, and walks away with almost double their money. A 95% gain. Amazing, right? But then there's the nightmare. Gold drops by just 10%. Now their position is only worth $90,000, which is exactly what they owe the broker. Their initial $10,000? It's gone, completely wiped out.
And that is when a trader gets the single most dreaded communication in all of finance, the margin call. The broker gets in touch and says, hey, your investment is losing value. You need to deposit more money into your account right now, or we are going to sell everything to cover your debt. Now, imagine thousands of traders getting that call all at once. Most of them don't just have that kind of cash sitting around. So to protect themselves, the brokers start force selling their clients' gold at any price they can get. This flood of selling pushes prices down even further, which then triggers even more margin calls. It becomes a catastrophic, self-feeding death spiral. This entire event is just such a powerful and frankly painful lesson about the hidden risks in our financial world. And it's a lesson that some of the greatest investors in history have been warning all of us about for decades. You know, the late, great Charlie Munger, he put it so bluntly. He knew that leverage was one of the few things that could bring down even the most brilliant mind. It's a force that you absolutely have to respect. And his famous partner, Warren Buffett, had a similar take, and his logic is just so simple and powerful. Basically, if you know what you're doing, you can build wealth without taking that kind of insane risk. And if you don't know what you're doing, well, it's just a quick way to go broke. So the real lesson from this whole collapse, it isn't just about gold. It's about risk. It's about knowing what you own. It's about diversifying. And it's about remembering that when you mix total uncertainty with a system loaded with borrowed money, that is the perfect recipe for a disaster. And that really brings us to the final thought here. This story is bigger than just finance. This principle of leverage, of being overextended, of being too exposed to a single point of failure, it can show up in our careers, our plans, our lives. So the question I'll leave you with is this: where is the hidden leverage in your world?